Hi everyone, I'm Kyungju, investment analyst at the Endowus Investment Office, and I'm here today to talk about the China equity portfolio. Here with me today is Sam, the Chief Investment Officer of Endowus, who will kickstart with an introduction of the portfolio.
So thank you, Kyungju. I'm really excited to introduce you today the China Equity Satellite Portfolio. This China portfolio is designed to deliver strong risk-adjusted returns in riding the Greater China equity market's long-term growth trajectory. Now, I'm sure everybody is familiar with the macro story of China and its high growth. So I'm going to explain more about why this portfolio is very unique. The first thing is the country allocation. Obviously, it's a country fund, so yes, it's going to have China, but it's a Greater China exposure. So there is some diversification benefits of having exposure to other markets like Taiwan and Hong Kong within the Greater China universe. A lot of companies have exposure to China, so maybe these portfolios can also give you exposure in the US ADR market or overseas markets, companies like HSBC or Prada that are either listed in Hong Kong or overseas as Chinese companies. Also, the sector allocation is broadly diversified. So technology makes the single biggest chunk of almost a quarter or slightly more of the total allocation, but it's a very broadly diversified sectoral portfolio. Now, the second point is that the portfolio, as you know, is Chinese onshore and offshore and Greater China. So China has a closed capital market, and its equity market is divided into multiple fragmented markets in Shanghai, Shenzhen, in Hong Kong, and overseas listings. And so it's important to have broad diversification within the China portfolio to the onshore stuff on the A-share market, offshore in the H-share market, primarily in Hong Kong, and also Greater China, which is markets like Hong Kong, but also Taiwan and Macau, etc. So this broad diversification gives us lower risk and volatility over cycles. So if we look at the underlying funds and how the portfolio is constructed, you can see that the biggest single allocation is to the JP Morgan China A-Share Opportunities Fund, which is the flagship core allocation and anchors the portfolio with its broad diversified and growth biased portfolio. It's added to that is the 5% allocation to the Aberdeen CCAP China A-Share Equity Fund, which has a quality and value bias, which anchors the volatility a little bit. Now, the offshore Greater China exposure is across three different portfolios. The first one is the First State Regional China Fund, and then the Schroders Greater China Fund, and also the Allianz All China Equity Fund. These portfolios provide us with that balanced and broad exposure in markets outside of China and also offshore. Now, I'm going to hand back to KJ to talk about why we invest in the China equities portfolio.
Thanks, Sam. So as Sam mentioned just now, well, we're all investing in China to participate in that tremendous growth. And just look at this chart. It just proves that the China market has undergone this crazy high growth over time. Well, it used to be a very stagnant economy in the past, but now they're one of the largest, if not the largest, economic superpowers in the world today. And there's no other economy in the world at this scale, at this size, that has managed to grow at a tremendous rate like this. But a question that we've been all getting from our investors recently is regarding their concerns on the China equity market, especially regarding the recent crackdown on sectors like technology and education. So our clients would ask us, hey, is it still safe to invest in China, given that there is so much risk from the regulatory side? And to this, we actually think that it's true that regulatory risk is not something that you can avoid when investing in China, because especially given the degree of power that the central government has in China. But we can certainly avoid the full blow of regulatory risk when it happens, as long as you diversify your portfolio well enough when you go into China. So if you look at the chart, regulatory risk is not the same across the various sectors of the China equity market. So this happened in the latest crackdown, and sectors like technology and consumer, they had it really rough, like we all know. But the other sectors like industrials, financials, they had it better than others. And this illustrates that it's possible to invest in China without sustaining too much regulatory risk, as long as your portfolio is diversified enough. And really, diversification is easy within China equities because the market alone is very, very large. The onshore China stock exchanges are the second largest stock market in the world if you combine them, only second to the US. And if you introduce Hong Kong as well, the universe becomes even larger. And what's interesting is that the respective stock markets, they offer different flavors to investors. So for example, if you're interested to invest in financials company, maybe you want to look at Hong Kong listed companies or even look at US ADRs. But if you are interested in, for example, healthcare, IT, or industrials, maybe you'd like to go to the onshore China market. So again, the Chinese equities universe is large and distinct and diverse, so there's a lot of companies to pick and choose from if you're considering to invest in Chinese equities. And really, overall, Chinese equities as a whole, they have a low correlation against global equities. Just take a look at the green box. And really, just having some Chinese exposure in your portfolio will give you a natural protection against the movements in the equity markets in the rest of the world. Lastly, there's a significant alpha opportunity in Chinese equities, especially in the onshore market. So if you look at the chart over here, this is actually the trailing 5-year returns for the funds in various investing in various regions. So we have like US, global, Europe, UK, Japan, Asia, and China. And the black graph is the median return of all the funds investing in each region. And the blue graph is the return of the top 25% funds in each region again. And if you see in onshore China, there's a large gap. There's especially a large gap between the average guys and the top performing guys. And this implies there are good opportunities in the market as long as you can discover them. And this may be because the China onshore market is relatively new to investors. So there's a lot of undiscovered treasures out there. But it's a complex market, you need local knowledge and so on. But if you have all this, you are in for a good upside opportunity in China. And this is further supported by this attractive valuation of Chinese equities. As you can see here, the P ratios of Chinese indexes are far lower than US companies or global companies. So as long as you can identify good companies, you can reap good upside in China. So with all these benefits, again, the important question arises, who should invest in China equities? And again, this is important because the Chinese market is highly, highly volatile. They're not only subject to events happening in the rest of the world, like global financial crisis or COVID, but they're also especially susceptible to political and regulatory risk arising because of the central government. There's a lot of up and down through the growth of China. And due to this, we only suggest investing in China equities if you are prepared to withstand a potentially steep loss arising from market volatility, or you have a very aggressive risk tolerance, or you have a mid to long-term investment horizon to make sure that your investment can ride out the losses that they sustain. Now I'll pass my time back to Sam, who will explain to you why you should invest in the Endowus China Equity Portfolio.
Thank you, Kyung-ju. Now, the first point is something that we've just already talked about, which is the diversified nature of the portfolio across different segments of the China market. Now, these ratios are not static, and that's the basis of an actively managed portfolio. These numbers will change over time as it has in the past, and that's the benefit of an actively managed portfolio where we will protect your capital and also increase the risk-adjusted returns of the portfolio by actively allocating to the best opportunities that exist across the different segments and geographies. If you look at the actual historical performance in the common inception date starting January 2018 to the latest numbers, you can see that the China equity portfolio, because of its actively managed nature, has proven to have done better than most of the passive index funds and passive indexes that are existing for China. The 14.45% annualized return is a phenomenal return, especially considering some of the major corrections that China has experienced in recent years. Obviously, the volatility is high. Absolutely, it's very high because China has higher volatility. But versus the index benchmarks, these numbers are not off the charts. It's around the same as the China A onshore and the CSI 300 broad passive index that we have. So the Sharpe ratio is tremendously better at 0.78 versus every other benchmark. Now, the one-year performance is obviously being consistent with the annualized return, very good. But the really important number here is the one-year worst return, because I think 20% drawdown in a worst-case scenario is actually a pretty good number. So risk-adjusted returns in China through the Endowus portfolio can be used to your benefit. Now, the third and final and most important thing is that Endowus Investment Office is providing you with ongoing assessment of the underlying funds. First of all, we have taken time to assess all of the many China funds that are out there to select and curate. We've assessed both qualitatively and quantitatively the various funds and tried to pick the best-in-class funds to be the building blocks for this China portfolio. Now, we provide ongoing reevaluation of these funds so that we make sure that the funds are doing what it's supposed to do, that the fund managers are continuing in its investment philosophy and its processes, and that they're not deviating from the strategy. And then, if it's necessary, we will replace funds or supplement them with new funds and portfolios to enhance the risk-adjusted returns for you. Now, I'll hand back to Kyung-Ju to provide a much more detailed deep dive into the portfolio.
Thanks, Sam. So going back to the portfolio allocation again, when we were constructing the portfolio, we had in mind to maximize the risk-adjusted returns of the portfolio by, as you can see, allocating primarily to the opportunities in the onshore market or the China A market, which is growing the fastest in the universe. But we also had a point to maintain a balanced exposure to the rest of the market, such as the Greater China and all China equities. Another thing to note is that we have worked really hard with the respective fund managers to bring you the lowest cost option available for this portfolio. So as you can see, the trailer fee rebates are pretty substantial. And on a portfolio level, you only pay around 1.01% per year, which we believe is one of the cheapest way to gain a diversified and really a highly efficient exposure to the China equities market. Here's a closer look into the returns and the risk of the portfolio compared to the other major China market indices in a longer term horizon. And as you can see, the returns of the portfolio over the years, they skew higher than most of the indices, while the losses and the volatility are relatively controlled. And importantly, if you look at the rolling returns, they also beat the indices on a long-term basis. Lastly, here are some selected names that the portfolio invests in, classified into Chinese companies and non-Chinese companies from Hong Kong, Taiwan, Macau, and other countries. And that's all the information we have prepared for this presentation. If you wish to learn more about this portfolio, please go to Endowus Insights. Thank you.